We generate free cash flow. We're buying back our shares. I'm a big shareholder. People can go on seti.ca and see what I own. I've spent about $750,000 purchasing my shares. We think that the market is incredibly short any kind of tonnage that's CORSIA eligible, even with the inclusion of Gold Standard and Verra. The big focus, as in many offsetting schemes, is not double counting. That's where having the corresponding adjustment is really valuable. So our project in Rwanda actually achieved the first correspondingly adjusted tagged credits within the Verra Registry, which is one of...
All right, today we're having a discussion with Michael Costa, the CEO of Base Carbon. Base Carbon is a financier of emission reduction and removal projects. Currently they have 3 projects, 2 of which are already issuing as we speak, and 1 is on the cusp of doing so. Base Carbon is profitable already, it's buying back its own stock en masse, and it might just be an interesting value proposition for you. So that's what we're trying to figure out today. Michael, great to have you on the show. Welcome. Perhaps we can start off with a short 1 to 2 minute introduction into what carbon credits actually are for the generalist value investor viewer at home.
Absolutely, and thank you for having me, and thank you for having us. We like working with you guys, and really excited about your new platform, both for Base Carbon, but also as viewers ourselves. So on Base Carbon, it's a really simple company. We, as you said in the get-go, we generate carbon credits. There's a number of different flavors and types of carbon credits, but the world really bifurcates into ones which are demanded by a government or a regulatory regime. The largest example of that would be the EU ETS, where companies are required to offset their carbon emissions with a carbon offset. So it's a ton of carbon that's either taken out of the atmosphere or being abated by being put into the atmosphere. And there's a number of different types of economic activities that will allow a company to generate a carbon credit and a carbon offset in this instance to be able to apply. The same thought process works in the part of the marketplace where we've initially focused our business, which is called the voluntary carbon market. So it's the same idea. It's largely for corporate or at a level consumer purchasers of these credits to offset their carbon footprint. In terms of generating carbon credits, as I said, there's a number of different methodologies, they're called, of how one can generate a carbon credit or a carbon offset. As I said, it really splits into 2 main categories. Are you abating carbon from being put into the atmosphere, or removing carbon from the atmosphere? On the abatement side, we have 2 projects focused there. They're household device projects, so they're effectively either clean cooking devices or water purifiers. They're distributed to families and low-income families in primarily LDCs that are typically cooking over 3 stone fires, heating their water, making it potable, cooking their food, and potentially heating their home. And these cooking devices abate a significant amount of the woody biomass that they need to burn to achieve those ends, achieve that utility in their life. So really good for the environment, really good for the family. Same thing with water purifiers. On the removal side, the world becomes a little bit more complex, but there's everything from planting trees, which we're doing in, as you said in your intro, in northern India, to planting blue carbon, which would be a version of a tree like a mangrove, planted in coastal areas, to technologically based solutions. So, on the highly technology based side, direct air capture. So running big machines that suck a lot of air through them to take out a little bit of carbon dioxide and generate a credit from there. So that's sort of the pantheon of what carbon is. But the world really is moving to a state whereby sovereigns, largely pursuant to Paris Agreement, are required to offset their carbon on a bilateral sovereign basis, and that's starting to trickle down to the corporates. So really think about this industry as a derivative of current and pro forma, sovereign statute around environmental regulation.
Michael, I think it was a great rundown. Thank you for that. Perhaps we can get started with one of your projects, Vietnam. It's a household devices project. I believe you're getting to the end of phase 1. Perhaps you can explain what you have done thus far there and how much cash it has generated for the investor at home as well. And perhaps we can also go into phase 2, how that will look for you.
Absolutely. And it's, and maybe I'll take 30 seconds and just move it a little bit upstream and talk about what Base Carbon is as a public company. And because I think that'll help frame what we've done and why we've done it. So as I said, Base Carbon, we're a publicly listed company in Canada. We trade under the ticker BCBN, Bravo Charlie, Bravo Nancy. We also have an OTC listing in the US. We raised, when we were still private, we raised about $50 million US dollars, give or take, of total capital. The vast majority of that we did in a co-brokered financing of the Bank of Montreal and Raymond James, with the use of proceeds largely to invest in these projects. As a junior market public company, we're a little bit of an odd duck, and you mentioned this in your intro. We generate free cash flow. We're buying back our shares. I was a portfolio manager and an institutional investor for over 20 years before I joined and built and founded this company with my partners. And there in the junior market, there's not a lot of companies that do that, especially in the early days. It's a little bit different. So I think that the viewership needs to put on their value investor as well as growth investor skill sets and hats when they evaluate the business. And we have that duality of value and growth. So with that backdrop, when we talk about Vietnam, to take it to really the high level, we allocated just over $20 million US dollars of capital into this transaction. To give people a sense of the timeline and the paybacks, because people know the timeline and paybacks in other industries, whether it be extractive resources or technology and everything in between. But carbon is sort of new for certain people. So within this project, as I said, we allocated $20 million US dollars. We signed this transaction in the middle of 2022. That capital was committed then and largely allocated over the back half of 22 into the middle of 23. And as we sit here now, in Q3 or the beginning of Q4, having just ended Q3 2024, we have done all of our program activities. So we distributed approximately $1.25 million clean cooking devices. So mostly clean cooking devices and then some water purifiers as well. So household devices within rural Vietnam, which is a huge undertaking in terms of distribution with our project partner Cipco, who are wonderful. I'll get to them in a second. I think that they're great partners and they're integral to what we do in Vietnam. But we allocated all the devices. We delivered this project on time and on budget. You made a reference to phase 1, phase 2. When we allocated capital to this project, what we wanted to make sure was protecting the capital of our shareholders and exposing them to the growth and the upside of this industry. Again, that duality of value and the duality of growth. Those two need in a nascent or a growing industry like this, they're inextricably linked. So we put in place through our project partner Cipco, through a complex transaction. We're good at structured finance. A fixed price offtake with Citibank, whereby Citibank took the first 7.4 million credits of this project. As we sit right now, we have allocated all the stoves on time and on budget, and we produced not only first revenues, but we've produced $30 million worth of revenue and effectively capital repatriation to us. So when you think about just simple investing, dollars out, dollars in, Base Carbon's allocated $20 million to the project. We've recouped $30 million to date. So, effectively two years and a quarter post signing the transaction, let alone the last dollar being allocated, we've gotten payback on the transaction and we've generated a 50% undiscounted rate of return already. We still have a bit more of our phase 1 offtake with our fixed price offtake with Citibank, and then we'll move into phase 2. In phase 2, we enjoy a $5 call option on every ton that is produced from this project. We do get called away on about 3/4 of those volumes, but we get called away at a double-digit price. So, that is that's a very happy consolation prize for us if that happens. We don't mind buying something at 5 and at we haven't disclosed what that price is for a number of commercial reasons, but the lowest double-digit price you can think of is 10. So even at that, we like the optionality in there, and we like the implicit double, and we have market exposure to the back quarter of that. The other thing we do enjoy in that project as well, thinking again about that, we've talked about the value side. $20 million out the door, $30 million back so far. That's good for investors. That's good for us as shareholders ourselves. It's good for us as a business. We also have structured into our agreement a 50% expansion option within the Vietnam project. So we can expand 50% of the devices at our choosing. So there's a number of different levels of optionality, and the optionality really speaks to the growth within that project.
Michael, great overview. You took out all my sub-questions into Finam, so that's great. Maybe we can do the same for Rwanda, and also perhaps where we should talk about there is you're holding the credits currently on your balance sheet because you believe there will be a re-rating event thanks to CORSIA. Stage is yours. Please explain what the project is all about and why you're keeping these credits instead of selling them right now.
Absolutely. And to address the last part first, just to give a little anecdote, there's a true difference between waiting and doing nothing. And there's one of the cardinal sins of a commodity producer or a near commodity producer is bringing your commodity on the balance sheet and taking that choice away from the portfolio manager. Again, I lived that for 20 years. That was my choice to allocate, the macro risk and the company's obligation to generate a risky return for what they did. For us, it is a very short period of time that we're holding those, and we'll get into CORSIA, but I want to make it very clear we're not sitting here saying we're holding these for forever. We're in the cash flow. We're in the carbon business to generate free cash flow, and the environmental commodities business to generate free cash flow for our shareholders. Not we warehouse risk. Those are two different things. But in Rwanda, to the first part of your question, it's a really simple project. It's very similar to Vietnam. Our project partners in Rwanda are the Del Agua Group, who are excellent. All of our operators, Del Agua Group in Rwanda, we've talked about CIPCO in Vietnam, and our partners V&V in India. Our three project partners were all handpicked at a level, and we sorted through so many project developers. And there's other good ones in the world that we don't work with that we look to, but these guys all three of them are absolutely world class in how they operate their business, and operating is so difficult, especially in LDCs, especially in distribution-based businesses where you're doing just large volumes of underlying widgets. To put it in context, in Rwanda, we're 250,000 stoves. In Vietnam, as I said, 1.25 million devices between stoves and water purifiers. And then India, which I'm sure we'll talk about shortly, we're planting or have now planted 6.5 million trees. Those are big, if you just concept, those are big numbers. So the operational excellence of our project partners is absolutely mission critical to what we do. The operational excellence also extends to government relations, right to operate, social license, and we'll talk a little bit about that with CORSIA and the LOA that the Rwandan government's granted within their carbon policy within the country. But the project itself is very similar to Vietnam in terms of flavor. As I said, 250,000 stoves. We allocated just under $9 million US into the project. And as we sit right now, we have 700,000. So we allocated that capital to give, again, people a sense of timing. We allocated that capital largely over the course of 2023. We signed that transaction early 2023. Stoves have, again, all been distributed on time and on budget. We've now had our first issuance within the project. That happened this year, much earlier this year. And so we have 700,000 correspondingly adjusted carbon credits sitting in Base Carbon's Verra account, and we'll talk about what a CA is and a corresponding adjustment CA, and why that matters and why everybody should really care a lot about it. We care a lot about it, and we just announced recently that we will, within in a very short amount of time, have our next issuance of approximately about 1 million credits on our balance sheet. So pro forma this issuance, which we're think about it as we're trade dates happen, we're just waiting for settlement date. But we're sitting on 1.7 million credits correspondingly adjusted. We do have a revenue split with our project partners, Del Agua. We don't disclose the terms of that for commercial reasons, but we have given some indication that in an indicative price of 10, I'm not guiding to a $10 price. We'll talk about price in a moment, but at an indicative price of 10, Base Carbon would net back $9. So people can do the simple math of what's on our balance sheet. In that project, we enjoy the first effectively 2.2 million unadjusted tons, or the 2.2 million gross tons are pursuant to this phase one of that split. And then we enjoy another 5.3 million tons, which will basically be the life of the project, whereby we enjoy a much smaller economic share, but it's much greater tonnage, and it's out the curve. Again, when you think about structuring a transaction, we thought very carefully about delivering the projects, underwriting, and then repatriating capital and being able to turn it, thoughtfully on our balance sheet. We've talked to, you alluded to it, I alluded to it, what's a corresponding adjustment? Why do people care? What's CORSIA? So a corresponding adjustment is effectively a rite of passage, if you want to think about it like that. It's a passport that a country, and virtually all countries in the world are, not all, a vast majority of the countries of the world have signed up to the Paris Agreement. And they have a certain carbon contribution that they need to do in terms of what they can emit, what they need to reduce. A corresponding adjustment is really simple. Think about it as bilateral, sovereign cap and trade. So instead of a government saying, hey, cap and trade, you're an airline or you're a power plant, it's just cap and trade between governments relative to what their NDC is within Paris Agreement. Really, really simple. So Rwanda has said, hey, the carbon credits from these tons, we will not count in our carbon math. Some other country can do it, meaning that a company operating in another jurisdiction is going to say, hey, I can buy those tons and I'm not double counting them, because it's not going to be counted in Rwanda because at the sovereign level, that's going to be counted as me as a corporate, which then aggregates up to a national level. It seems really complex, but it's actually really simple when you had a few minutes to actually think about it. So Rwanda's given this corresponding adjustment. Why do we care? We care because that's the mechanism into the vast majority of compliance schemes in the world to offset and reduce carbon. The main one that we're focused on right now, and you brought this up before, is CORSIA. CORSIA is a really, really long acronym for the Carbon Offsetting Scheme for International Aviation. I knew it at one point in time. There's way too many acronyms in carbon. I'll just tell the listeners this as they go down the rabbit hole and they look at it. I do this every day for 12 hours a day. Don't feel bad about the acronyms. There's way too many. The industry needs to get rid of them. It's silly. But in any event, CORSIA is the international, I'll use the word regulation, but with a lowercase r, that international airlines have signed up to. So it's over 300 airlines in 200 different countries, virtually all of the G20 countries. So, any sort of, non-LDC country that people are flying into will be subject to CORSIA. And it's the offsetting of the hydrocarbons burned by the airline industry. So within CORSIA, the big focus, as in many offsetting schemes, is not double counting. That's where having the corresponding adjustment is really valuable. So our project in Rwanda actually achieved the first correspondingly adjusted tagged credits within the Verra Registry, which is one of the two major registries within the industry. So it's a really, really big benefit to us commercially, and we got both good because of our work and the deep work of our project partners in Del Agua, as well as lucky to have the first tag there. But to give people a sense of CORSIA, and our credits, I want to be crystal clear, are not CORSIA eligible yet, because Verra and Gold Standard as registries have not been onboarded to CORSIA. And there's a process that's ongoing this fall that there's a potential for both of those to be included. Probably outside of the scope of the time we have to go into the nuance of all the machinations of CORSIA. But to put it in context, if you look at the people can go on the CME ICE website and look at their CORSIA contract. The last price I saw sort of like late last week was high 16s, low 17s for a December 2025 settled transaction. So when you put that in context and you look at our transaction, you say, wow, I don't know what the split is above 10, but I've given you an indication that, up to 10, we enjoy 9 out of every $10. You sit there and say, wow, even if that next part of the split was whatever, make your assumption, 25%, 50%, 75%, people can run some sensitivities. On the front end, people can do the math. 1.7 times 9 is, and we allocated 9 million US. That's almost a double right there of our initial capital. So payback plus capital, and that's without upside. So that's why for us, that tie back and tie through to CORSIA is really, really important and really important commercially. We also think that the market, if you look at just the supply and demand of CORSIA, even in the early 2 years of CORSIA, we think that the market is incredibly short any kind of tonnage that's CORSIA eligible, even with the inclusion of gold standard and Verra, because there's just not enough CAs of approved projects that'll flow through. So we think that there's an incredible amount of upside to the CORSIA market in the short term as a result of that. And we really like the long-term optionality for our continued production with our partners in Del Agua in Rwanda into hopefully, touch wood, CORSIA.
Excellent. Another great overview. Thank you, Michael. For viewers at home, a bit of disclosure, I am a shareholder of Base Carbon, and I definitely think the company is undervalued at its current level. But that CORSIA inclusion potentially happening, phase 1 is currently happening until 2027. That is really a free call option as I see it for that upside in the VCU market. So very interesting. Thank you for explaining that, Michael. Perhaps we can roughly do the same for India. And perhaps you can also explain to us that project is only going to generate 1.6 million credits, nameplate capacity, let's call it. Perhaps you can explain how still the project makes sense if you compare it to Rwanda and India, who are generating significantly more.
Absolutely. It's a great question. So in India, we are working with our project partners, VNV. I just talked about Del Agua. I still have a little Del Agua left on the tongue. With our project partners, VNV, who, again, like our other two projects, they're absolutely world-class people, world-class operators. And we're planting 6.5 million trees in the UP province in northern India. We're planting on smallholder lands, so 5 hectare or less plots of lands with existing farmers. And we're also, in addition to the carbon sequestering trees, we're planting fruit and nut trees, we're putting in water infrastructure. So it gets to the social license of, hey, why do we get to do this? Why do the farmers want trees on there? Does this make sense for them? Is there permanence? This is an incredibly high quality project. And if viewers here, everybody says whatever they've got in business is high quality. You hear that, I've sat on the other side of the table from 10,000 companies. When you look through the pantheon of the types of things for afforestation, reforestation, quote, ARR projects, there's very, very few that have this level of touch, that have this level of community benefit, that have this level of staying power. Not only just permanence within the calculations of carbon, but real staying power, because the farmers really need and want these trees and this activity on their lands. Because India's really, really wet during monsoon, and it's really, really dry when it's not monsoon. So irrigation becomes really, really valuable to the farmers. Having cash crops that are outside of their baseload cash crop, again, in fruit and nut trees, become very valuable. So it's a real I'll use another overused business term. It's a real win-win for everybody. But so within India, we've committed to about $13.5 million US for this program of activities. But carbon does things weird. Carbon takes growth capital, sustaining capital, and OPEX, and adds it all together and says, that's your capital amount. That'd be really weird to go to a mining company and be like, hey, tell me how much your truck's going to cost to replace your tires in 7 years, and put that on the initial capital amount, and how much your engineer and your long hole driller. It's a really, really, really silly thing that carbon does. And I think it does as a macro concept get back to the idea that there's so much growth to be yet to have in this industry when you have that lack of sort of detailed financial sophistication across an industry. So, but we are participants in the industry, and we want to make sure that what we tell people is apples to apples. So that is the headline number, but that's literally all the capital. So when you break that down, we've really bifurcated it into growth capital to plant the trees, then that sustaining capex. There's really not a lot of opex because you've planted a tree. We do have, as well as an aside, we do have mortality guarantees with our planting partners through VNV in India, that any mortalities of tree plantings, they take care of. We've paid for effectively turnkey trees. And we've seen that on our plantings to date, where we've had mortalities are right in line with what we expected, and they've planted them exactly as we expected, so everything is sort of humming along really nicely there. Within that project, so the punchline of all that is that the actual capital at risk to our shareholders is way less than that headline number, way less. And people can go to our financials and see how much capital that we've allocated. I know the exact number, of course, but we're also we're pretty close to issuing our next financials, and I don't want to say the wrong thing and get slapped on the wrists. So within that project, the key question is, Well, why would you do, you spent $9 million in Rwanda and you're getting, you already have 1.7 million credits. Why don't you just go do more of that? Why are you doing this? This doesn't, apples to apples, it doesn't make sense. And as I said in my prelude, there's a difference between removing carbon from the atmosphere versus abating carbon. We like carbon abatements. We think it's a key part of the industry. We think it's a key part of carbon regulation. We think there's real staying power to it, but it's got to be the right project. I can't even give you the exact number, but we sorted through 20, 30, 40 abatement projects, household device projects in lots of different places. That the project was great, but the project developer hadn't done it before. The developers were great, but the project, it's very much a rifle shot. Within ARR, you can take more of a shotgun approach to ARR as just a concept of credits, but we definitely, of course, took a rifle shot approach with our project development partners and the type of project here. These credits will trade for much higher prices than the abatement credits. And we think that from a pricing standpoint of the credits, there's way more upside in here because there's such a lack of growth. If you talk to the largest buyers in the world, largest tech companies in the world, airlines, oil and gas companies, the thing that's consistent amongst all of them is they say, oh, wow, we really, really want high quality credits. Great. Which ones? We want the best quality credits, right? Great. What does that mean to you? Generally, it means projects of our type, but there's longer paybacks. There's a lack of any kind of tranched financing available to this industry. It's largely equity financed. You need to, planting a tree, unlike anything else, it literally is bounded by nature. It takes time. So if the industry comes and says around 2030, hey, we really, really, or 2077, or whatever the year is, we really, really want these tons, there's no tons. So that's where we've seen this. We saw it in the 80s or 90s when the short squeeze on silver was with the Hunt brothers. You see commodities get convex and really, really convex, and there's all these little pockets of differential within carbon. So we really like that exposure. The second thing that we really like in this project is we think that this project is the widget itself at a level instead of selling the credits. What I mean by that is I think that where we'll get to eventually, and this is not guidance, this is a view, I want to be crystal clear, is that one of the large buyers will step in with either an offtake for the whole project, and we still bear operational risk, but it's a pass-through, very much like we did in Vietnam, but we did it for the first phase of Vietnam. Imagine for the entire project. Again, whether it be a bank, a airline, a oil and gas company, or a power producer. And with that de-risking allows us to expand. So when I look at what our actual sort of probabilistic paybacks are and our financial return in this asset, I can't go out there and put in my financials because it's not something I have in hand. But we have the strong view that we're going to be able to turn our capital on our balance sheet much more thoughtfully than the headline paybacks that investors see in the financials. That's what's out there. That's what people need to rely on because that's what's set in stone right now. Stone's the wrong word. That is our best estimate of the world, the way the world looks given all of the pertinent information currently. But I think that that's what we do. We also, as we talked about in Vietnam, where we enjoy a 50% expansion option in Vietnam, we enjoy a 10 million tree expansion option with our project partners VNV in India, and we really like working with the VNV guys. As we move to begin to monetize this project, I see a lot of other course of business that we can engage in with VNV, and to me, it's that next stage of where's there that long-term demand in the marketplace, and where's their optionality. Again, going back to the beginning of the conversation, that duality of value and growth. I guess pun intended because we're planting trees on the growth side. The other thing I'd say in India is when I think about the scope of activities, the optionality is not only on price but on experience. So again, as we talked about, it takes a long time to grow a tree. The paybacks in this industry on the AR side feel pretty pedestrian. I've lived through other commodities, in metals and mining in, let's say, the mid-aughts, when somebody would sit there and say, oh man, I could either give you the best asset in the world or I could give you a mining engineer. You probably would take the mining engineer instead of the upstream asset because there's that lack of experience. I think the same thing's true within this industry. And, I want to be clear, the operational expertise resides within our project partners at VNV, but we have such a close working relationship with them. And there's a lot of first mover advantage and moat in just acting with properly scaled capital in the way we are right now in ARR.
Michael, thank you. Really appreciate that. I would like to squeeze in one last question, if that's okay with you. I know you're strapped for time. Since your renewed and normal course issuer bid, you've actually been buying back a lot of shares, 4.2 million since June. That's 3.6% of your outstanding shares. Perhaps you can outline what your rationale is behind doing this instead of investing in that call option to plant 10 million extra trees or to start a new project.
For sure. So when I think about options, for those that are more of the financial minded on your call, I think about theta, time value of that option. Our option in Vietnam, we get to declare every year whether we want to call our amount of credits that are expected for that year. Our expansion option in Vietnam inures, for a very reasonable period of time. Our option to expand in India inures for a very reasonable period of time. That optionality, whether I have 3 shares outstanding or 200 million shares outstanding or a gajillion shares outstanding, those options are there and the theta is there. So I don't really feel that compelled to have to go and exercise that option tomorrow. Optionality itself is inherently valuable. The second thing is when we think about repurchasing our shares, and this is again out of the institutional investor skill set, we need to be the best buyers of our own business. We understand it the best. We spend all of our professional time on it. We've got a really, really slick team who's super duper smart, focusing on a number of the nuanced parts of our business. So for us, we understand our business, and this is different than a company buying back its shares in an established industry where they're making a bet. I don't think we have to make too many bets buying back our shares, and all of that optionality and all of that growth that increases for shareholders. Typically, when you see companies buy back their shares, they're trading off. They're increasing the growth exposure to their shareholders, but they're really trading off the value side. We don't have to do that. We're the junior market's really bad right now. I see it in my PA and a lot of the different things that I own. My ex-peers and colleagues who are still managing money professionally see it. The junior market is really hard. And we could probably spend another 2 hours on, the cost of money and monetary expansion policy of why and how that is and how it adjudicates. But everything is cyclical. Acorns don't grow to the moon, and it's always darkest before the dawn. Those are simple sort of schlocky heuristics, but markets don't go. When times are really great, they don't last, and when times are really bad, they don't last. Things are cyclical, and we're just closer to the bottom of a junior market than the top. That's a good thing for us because we have the cash to be a buyer. So for us, though, we've got. And I have our most recent share count. So I don't have our last quarterly financials in front of me, but we've got about 100. I think it was around 115 million shares out as of the last quarter. And as you said, we've continued to buy back our shares. I would say thoughtfully but aggressively. As of the end of the quarter, we had $7.5 million of US dollar cash on our balance sheet. Subsequent to the quarter, we announced $11.2 million of offtake back to Base Carbon from our subsequent issuance. It was subsequent at the time. It's now in the past, of course. So that's 18.7. We burn about $4 million a year, so $1 million a quarter. Take that down to 17.7. We've bought back some shares. We've invested some further capital into our India project. So investors can make an assumption of what cash is. I don't want to blurt out a number. I'll just use the actual 18.7. But if you do, and I'm going to actually do the math with your investors on the phone. Do 18.7 as of the end of the quarter times 1.36 to turn into Canadian dollars. It's 25 million Canadian dollars. Divide by 115. There's 22 cents a share right there. Now, we also know that we've got the 700,000 credits in Rwanda sitting on our balance sheet with the other million that'll come soon. Let's just use that $10 price, let alone any upside. And again, I want to be absolutely unequivocally crystal clear. I'm not giving pricing guidance. This is just a for instance, and it's an easy one because we've used it in our financials. But 9 times 1.7, that's 15 point, and we do think that there's upside from there, just to be crystal clear. I want to be very clear about that. So that's 15.7 times 1.36. There's another 20 million Canadian dollars divided by 115. That's 18. So we had 22 cents of cash plus 18 cents of Rwanda. We have further fixed price offtake in Vietnam to go. We have further phase one, a little bit, not a ton, but still some further phase one of Rwanda left to go. But there's 40 cents a share. The market is like 45 cents a share Canadian right now. We're thoughtfully buying our shares. So at the margin, let's talk about again that duality of value and growth. I'm trading off 5 shares of implied EV to get the entire growth side of my business for free for my shareholders. I'm a big shareholder. People can go on seti.ca and see what I own. We've paid for, and my business partner and co-founder Wes, as well as our other founders, our sister company Abex, and that those guys, like, we've all paid for our shares. To put it in context for me, because all politics are local, I've spent about $750,000 purchasing my shares. I think about this business as a principal first. We obviously think fiduciary, but I like where there's alignment. We've purchased a lot of shares ourselves for ourselves and as families and as individuals. We'll keep purchasing shares, but I can't be purchasing shares as an individual if I think that the value is that much as the company. We're not a trading desk, but I've got to put our shareholders first, right? And it's just, in our mind, it's too good of a deal. And as a shareholder, I enjoy that accretion. So I don't mind sitting there and using our free cash flow to buy that optionality, because I can always go and expand a project. I can't always get this kind of expansion of growth for my shareholders and exposure to it.
Michael, thank you so much for your time. Appreciate it.
It's really nice seeing you guys. Thank you for doing this, and congratulations on the new pod. It's super exciting.
Thank you so much. Appreciate it.